Hello everyone. Starting a minute or two early, so I can just check, make sure that everybody can see me there. Yeah, I'm in. There, get the symmetry right. It's Theunis Kruger here, my FX trainer with Forex Time, and we're going to talk today about the introduction to Forex Basics Part II. Right, before we start, can you guys hear me? Can you see me? I'm checking my sound on this side. Everything looks fine. Let me see who's in attendance. Smarty, I like that name. Smarty, can you hear me? Can you see me? Avive, David, can you guys hear me? Can you see? Yes, Smarty, Azay, Herman, that's good. Right, let's start. As you know, this is for beginners. So when you begin, everything is foreign. You don't know what the language is about. It's almost like learning a new language. So it's very important to get the terminology, the definitions, and so on right. So this is what this presentation is all about. Please, if you've got any questions, then let me know. Then I'll answer them as soon as possible. See it? Yes. Right. What we're going to talk about is a short introduction. Then we're going to talk about the different currency pairs. We've got the majors, the crosses, and the exotics, what they are, what's the advantages, what's the disadvantages. Profit and loss, how do you calculate that? How does it work? You need to understand that. When you look at your MetaTrader, there's a couple of terms there: balance, equity, free margin, margin levels. We can explain exactly, talk about what that is, and show you a few examples on a demo account. See what the effect of those things are, what a margin call are, what stop out is. That's things you don't want to ever experience. What swaps are, it's important. And then quickly look at the website and questions and answers. Now, initially, I just want to start out with showing you that these things are on our website. If you go to the website and you go to education and you go to short educational videos, all the terms that I'm going to discuss is discussed there. This is part 2. Part 1, we talked about pips, what is Forex, all the other basics. So, and it's also there. So here you can see we can talk about the majors, the crosses, the exotics, what is a lot that we also discussed last time in the first part. Here's all the what's leverage, what is margin, balance, equity. So please guys, the reason we put it up here, the reason we have webinars about these things is because of the way we learn. We learn by repetition. Every time you learn, in your brain, neurological pathways, it's set down. So every time you learn, more pathways are set down, and as you learn more and you get to know this thing, it forms like a neurological tree. So, and that's when you start to get insight and so on. So you have to repeat it a couple of times. And the reason we do it like this is you can read it here, you can see it there, listen as well. And then with a webinar, you hear it from a different perspective. So, and if you are brand new and you don't understand these things, don't be hard on yourself. Remember what I said, every time you learn, it's going to get better. Every time you repeat it, repetition is the mother of learning, they say. So that is, it's going to become easy for you, and it's you're going to start to understand it. It's like with any new skill, any new language that you learn in the beginning, everything is foreign. But the more you repeat it, the more you just stick with it, then it starts to make sense after a while. Right, my introduction. You guys that know me, I always talk about a little bit about the foundation. We've got two sides of this business, or online trading has got two sides of the same coin. The first side is unfortunately the side a lot of people are introduced to and get stuck, and that's what I call the entertainment side, the entertainment trap. That's focusing on methods and strategies and all these things, and thinking that alone is going to make you successful. Now, it's very entertaining, but it doesn't make you successful. As when you talk to an experienced trader, many of them will share with you their journey, and and how they were entertainment. It was very entertaining in the beginning, but they didn't understand the foundation or the basics of the business. And then the other side of the coin is the business side, which is based on business principles. And the foundation very quickly is we do technical analysis. We look at those charts for a specific reason. Right, and you have to deeply understand that reason. The sooner the better. I have got webinars. That's what we'll do on the seminars and the seminars as well when we go to people. Tomorrow we're going to Rustenburg, I'm leaving tomorrow, but we have a Saturday a seminar in Rustenburg. We discuss this foundation. So, but we've also got recorded webinars. So if you haven't seen that, if you don't understand what I'm talking about here, then it's very, very, very important to listen to that webinar as well. I'm not sure if it's been put up on the website, but with GoToWebinar, which we use to record these webinars, it's definitely there. So you can just email me, and then you can just email me, and then I'll send you that link so you can watch that. That's before you start. I see there's some questions already. Somebody who has a account wants to know about the lot size. Right. Okay. So that's before you even worry about those things. So you must understand what this business is all about, because or else you will get stuck on the entertainment side. Very easy there. Very entertaining, but you don't make money. You have to focus on the business side. So we do technical analysis. You have to deeply understand that. And if you understand technical analysis, then you will understand that all you need to have a positive cash flow in this business is a very, very simple and well-defined method, proper money management, and you must practice that over and over and over and over. Those combination of those things combined with your with proper usage of technical analysis, and as you practice and you practice and you practice and you practice, then it starts becoming easy, and then you start becoming proficient. The emotions is practiced out of your system. It becomes mechanical. It becomes intuitive, but it takes time, guys. You can't take shortcuts. When you start learning something new in your brain, it's like there's not a lot of information. It's like a few neurological pathways there. So, and when you try to do something and you're not prepared enough, you haven't got the skill yet, you haven't practiced enough, that's the time when you feel your heart going through your chest, you feel it pumping and you feel the emotions. That's your body warning you, you're not well prepared yet. So, not well enough prepared yet. So as you practice and you practice and you practice these things, this understanding, and I tell the guys in the beginning to put a clean chart, just no indicators on. Zoom out a little bit to see that structure there, the rhythm in the market, the uptrends, the downtrends. And that's when technical analysis also starts making sense, right? So if you don't understand this, very, very important, please get that webinar, email me, then I'll give you the link to the webinar. As well, there's a couple of things that I think Associate is asking about lot sizes and so on. That's dealt with in the first part. I can send you that webinar as well. We'll keep to the agenda for this part. This is the second part. Right, so let's get going. Currency pairs, there's lots and lots and lots of currency pairs, but overall you can group them into three groups. The majors, and very, very important about the majors, is most of the volume is registered through these ones. Now, I'm just going to quickly go through them. You'll recognize them. When you open up your MetaTrader, you'll see them there. I'm just going to show you. I like to be a little practical. When you open up your MetaTrader and you go to Market Watch, then you see all the currency pairs there, right? Currency pairs, commodities, all these types of things. Right, this is what we're talking about now. So this is the majors, the major economies in the world. Euro USD, the Euro Yen. This is the strongest economies in the world. Aussie dollar. They've got some nicknames: the Euro, the Yen, Cable, Aussie, Swissy, the USD, Swiss franc, USD, Canadian dollar, Loonie, and the New Zealand US dollar, Kiwi. Right. So these are the majors. Very important to know that the volume, 80% of the volume that's registered on it goes through the Forex market. And it's a decentralized system working through mainly banks. That's the backbone. Deutsche Bank, I know, is one of the biggest backbone banks of the Forex market. 80%, guys, 80% of the volume goes through these majors. I'll speak about that a little bit later. That's very, very important. That means that the volatility, there's lots and lots and lots of people trading, high liquidity, lots and lots of people trading. That means the markets are more stable than when there's not a lot of people. There's not a lot of people, the market goes up and down, spiky or porcupine markets like we say, because there's such a high volume there. They have a lower volatility. So high liquidity, lots of people trading there, makes the markets, the waves, the market structure makes it a little bit more stable. Because there's so many people, there's less, it's less susceptible to manipulation. That's also very important. Manipulation you will see in markets that's low liquidity, you see those porcupines, and also low spreads. So because there's a lot of people trading there, the competition is high there. So between the different brokers, so the spreads are very low there, the commissions. All right. The second batch is the crosses. That's not the that's a cross pairs of the different currencies. So and you've got for instance the euro yen, the New Zealand Japanese yen, British pound yen, euro British pound, and so forth. It's actually more of them, but we're not going to discuss all. Very important about these ones, there's no USD currency there. So that's all the other ones crossed over to each other. So, and remember what Forex is all about. It's foreign exchange. So it's people exchanging money. So it's if I go to the previous one, it's like you want to, if you've got a business in Japan, you've got a business in Britain, and you want to do business, and you have to exchange the the currencies for each other to be able to do business. So that is that's a big part of the guys that use the Forex market. That's why the volumes is so huge, like $5 trillion a day. That's the turnaround, the money that's traded on those decentralized markets. Right, there's no, with the crosses, there's no USD. Definitely lower volume, more volatility, more jumpiness in the market, less liquidity because there's less people trading there, and therefore it's more susceptible to manipulation. Big players, when a big player comes into a pair like that, it takes a huge position, then it moves the market. So some of them are nice, but you have to be very careful, especially on the lower time frames. You see that spikiness, that porcupine type of thing that you see there with the charts, because there's less volumes. There's also bigger, but higher spreads, and overall it's riskier to trade. So remember what I said with the majors: 80% of the volume goes through the majors. That means for the crosses as well as the next ones, the exotics, is the remaining 20%. So that in itself tells you to be careful. Right, the other ones is the exotics. Now that is smaller emerging economies. So the impact of them on the world economy is not so drastic as the majors and the crosses. I'm just going to show you some. You've got the USD, South African Rand, USD, South African Euro, South African Rand, Euro, Turkish Lira, and so forth and so forth. So there's lots of them. Okay, the exotics, emerging economies, lower volumes, lower volatility, less liquidity. Be careful. More susceptible to manipulation. Some of you guys have looked at the South African Rand, the USD South African Rand. You'll see those spikes there. That's because there's less liquidity there. Okay, higher spreads, even more risky to trade than the crosses, so just be careful. What I must say is, if you have a firm grip on the basics, if you know what technical analysis is, if you practice, you've got a simple, well-defined method, you've got proper money management, high probability management, money management regime, and you are well trained, you've trained yourself well, you've got good discipline, then I know traders that on every time frame, then there is a trend, there is a structure, and you can make money, but you just have to be more careful, especially with the higher spreads on lower time frames. So that's things you have to look at. Okay, profit and loss. We're going to look at a few examples. Right. Vive, sorry if my pronunciation, asked, what about Bitcoin, Bitcoin USD, and gold? Okay, they are, yeah, gold. They are also there, but not on every account. We've got different accounts. I'm actually planning to do a webinar about the different accounts as well. For instance, on the demo account, I don't think there's any Bitcoin, but on the standard account, there's definitely Bitcoin. And the reason not all the instruments are on all the accounts is to do with the liquidity providers. So we use different liquidity providers, and some of them just don't, they're not willing to provide liquidity for certain instruments. So, for instance, on a demo or a Sense account, there's the purpose of a Sense account is still to practice. So not all the pairs are on there, but the purpose is for you to practice. So when you get to a standard account, you must actually know what you're doing. You must have some skill. You must have practiced your skill. Then I know Bitcoin is there and all the currency pairs. And ECN accounts, then again, I don't think the cryptos are there because of the way the ECN accounts works and the liquidity providers we have there. So you must choose your account carefully. There's as well on the education part, you'll find information about the account types there as well. Okay, so let's go on. Profit and loss. What we're going to look at here is how do you calculate your profit and loss? How does it work? And the idea is to give you guys a framework to start to understand how it works. Right. Let's say, for instance, you bought one standard lot. If you have one standard lot, then you control 100,000 of the base currency. So in this case, the base currency is euro. If you don't know what the base currency and the quote currency is, then we're just going to look at the first part again. I explained that there. So base currency is 100,000, and yeah, that's how big the contract is that you're controlling. And let's say you bought one standard lot size at that price, and you closed out the position. That means you made a 9 pip profit. As you guys remember, pips is the fourth digit, except the USD yen pairs. They've only got 3 digits, and the pip is the second digit. Okay, so this is the Euro USD, so it's the fourth digit. So we count, and we've got a 9 pip profit. Right. So now, how much is that worth? How much profit did we make? So this is a standard, the standard formula that you use. The base currency times the amount of pips gives you the value in the quote currency. So let's see how that plays out. We had one standard lot size that represents 100,000 for the base currency times 9 pips is 0.30, and the fourth digit we've got the 9, and then you get $90. So in that transaction, your profit was $90. Now I've had a number of questions about this. And I know there is calculators that you can use to work out lot sizing when you want to know what your lot size is before you take the position. So, for instance, when you have a position and you know in pips, your risk is going to be 10 pips. How do you know how much lots you must take? So, personally, I use a calculator for that. Baby pips and so on. There's a couple of them, but the safer way to do that is when you begin, you will obviously begin on a demo account because you have to practice. In the beginning you're gonna make mistakes, so rather make your mistakes on a simulator or a demo account and learn and grow until you don't make mistakes anymore. Because if you make your mistakes on a live account, you're gonna pay school fees. You'd rather pay time and learn and grow until you make less mistakes and not mistakes. You only take good trades after a while, and then you move on to your live account. By all means, open an account, fund it, but be careful if your skill levels are not good enough focus on the demo account first. Actually, I tell the guys in the beginning, before you focus on the demo account, you have to know what you do as well. So you on the historical charts, you test your simple, well-defined method combined with your money management. You see how it plays out. You build confidence in the method that you've chosen. Right. So the bottom line is, what happens is if you practice on the demo account, you're going to start taking positions, and then you will see there what happens. You'll see what is the values, and then you get a feel for how much risk you're taking, and you experiment. So and then you'll get to know this. You'll start using these type of equations as well, so you get to know it. So don't rush yourself. Don't jump into it. If you don't even know what these things are all about, if you don't know what I'm talking about, it just means you still have to practice, guys. And like I said, don't be too hard on yourself. Give yourself time, but don't try shortcuts. One of my mentors used to say, the long road is the short road, and the short road is the long road. What that means is the long road, if you prepare properly, build your skill, train, then it's a short road to success. But the short road is the long road. The short road, shortcuts, trying to do things before you're ready, leads to a long road of frustration. So that's the entertainment trap. The long road is the business way, getting to know it. Okay, right. Let's go on. We're going to use a different example just to find out the value in the base currency. So that was that value we were getting the value in the quote currency, right? So the second one. So now we're going to look for the value in the base currency, and all you have to do now to get the base currency involved is we take the same equation, but we just bring the exchange rate in. So we've got the amount of base currency times the pips divided by the exchange rate, and then you get the value of the base currency. In that transaction of ours, it's 100,000 times the digits for the pip, 9 pips, divided by what the exchange rate was, and then we've got the USD euro, we've got the euros, what the value is. So this is very, very important to practice. Give yourself time to practice. Don't focus on the money too hard, because without the skill, you will never make money. That's just how it works. So if you focus on the skill, the money will almost come by itself later as your skill level picks up. Right. Luckily, I know a lot of guys don't like the equations, but luckily there is, like I said, calculators and so on that you can use. But still, it's good to know what it's all about. You know, how is it calculated? Then that will save you from mistakes like making an extra zero. Some guys, they want to risk like $100, and then there's a zero extra because of the lot size that they didn't do properly, and then they're actually risking 1,000. So it's a big difference, big difference. So we want to prevent that. Right. So let's look at another example. We're going to sell. We sold one standard lot again, 100 of the base currency. The base currency is USD in this case, so it's US dollars, and the USD Japanese yen. So we sold at 113,600. We closed at 113,670, and we have a profit of we have a loss of 7 pips. Now this is going to happen. This is definitely going to happen because I know it's also a bit almost like the mental part of trading, but I like to mix it in with these things so you can get prepared. We are not predicting the price, guys. So if a person says he can predict the price, he knows what's going to happen, then in actual fact, what he says is he knows all the people that's going to trade on the market. He knows their strategies, even knows their timing. That's not possible. What we're doing is we're doing fundamental analysis. We're looking at certain stages, initial stages of the next trend, and we take a calculated risk there. Never ever do we believe that we can forecast the price, that we know what's going to happen. Nobody knows what's going to happen. So losses will definitely happen. You have to prepare yourself for that as well. And part of the preparation, which is very important, is the old charts. When you're practicing on the old charts, you'll see not every transaction, not every trade you're going to take is going to make a profit. Some of it you're going to have to take a loss, But what you're actually doing is you're protecting your account. It's a calculated risk that you're taking. Right, that's very, very important. So if you're expecting at this stage to win every trade, then you're still firmly in the entertainment trap. Okay, it's not going to happen. That's why we have to manage our risk so carefully. So, but if we do it right, then over a series of trades, yes, it's possible. Like with any business, we can make a profit. Your skill levels are good. Right, so let's say we look at okay, we've seen that example. So now we're going to see how much is that in the quote currency. Again, the same formula, amount, $100. This time it's a loss. And you remember the pips with these Japanese pairs are the second digit. So, and that's how much yen we lost. Okay, let's look at in the base currency. Take the same one, just bring the exchange rate in, and we made a loss of 61.58 US dollars. Right. If it is Greek to you, watch it again. Send me an email. I'll send you this. I'll send you this webinar. Watch it again. Watch on the other videos until you begin to understand how it works. And believe me, it does. Just have to keep on going, keep learning, like with any language, any skill. Right, now we're going to look at I'm just going to jump to my MetaTrader first. When we go on MetaTrader to the terminal part, you're going to see all the information we can talk about here. Some guys don't understand, or they still have to learn what's going on here. So that's what we're going through here. Right. So the balance, you've got different titles there, the balance, or different headings: balance, equity, margin, free margin. And what you must understand, they're all interlinked. So the one has an effect on the other one, and we're going to see the relationship between them now. Right. Firstly, the balance, that's the left one there. And the balance is simply the amount of money in your trading account, excluding any profits or losses in open positions. Now, when you're still trading, with 1 or 2 positions, doesn't matter so much. But if you start getting proficient and in a while you've got a couple of positions open that you're managing, then that becomes very, very important. So then all these things you start to understand why they are there and the reason why they are there. Right. So let's go on. We've got the balance there, the amount of money in your trading account. Remember, excluding any profits or losses. So example 1. So that is the amount that we have there. Okay, equity. What is equity? What's the difference? Equity is just next to it. And simply put, the amount of money in your account, this time including any profits or losses in the open accounts. Now, this can have a dramatic effect if you have large losses. Looks like you've got a lot of money, but there's open positions, and you'll see your true reflection with your open positions. We'll see there. Same with profit. Might not look so good, but if you've got open positions there and it's in profit, then that is actually what is going on in your account. Right. So in this case, the balance minus the open loss of 67 gives you the equity in your account. Okay. Free margin. Now, as you guys know, when you open a position, then a deposit is put down. Depending the size of the deposit, or the margin as we call it, depends on the amount of leverage that you have. If you've got a lot of leverage, like 1 to 1,000, it's a small deposit that you put down, or a small margin. But if you as your margin or your leverage gets less and less and less, then your margin is bigger on the size. So that has an effect on how many open positions you can have. So it's very important. So there's your balance, and that's the amount that's available for you to open new positions. Right. Some guys ask me why is that in such an aspect. Now, in the beginning, guys sometimes don't understand that the bigger portion of the account that you use to trade with, let's say you trade with 10, 20, 30, 40% of your account on a trade. In the first place, the mental stress is enormous. And if you lose one trade, then you lose 10, 20, 30, 40% of your account. So sometimes at the beginning, guys don't understand that, and they trade with huge amounts of their account, and they don't even understand what's going on. So that's That's like a warning to tell you, listen, am I trading responsibly? Am I doing my risk management right or not? Right. So an example is we've got the balance minus the open loss minus the margin. That's the amount of margin that was deducted from your account, and that's what's left for you to trade with, to open positions with. Right. Okay. Now there's another way to calculate that. In this case, we use the balance. You can also calculate that just using the equity. So because the equity is just the balance plus or minus that. So in this case, the equity minus the margin gives you what you've got available to trade with. All right. Okay. Free margin. It's not actually free margin here. The balance, the equity, the free margin. If you've got no positions open, then they're all the same, which is obviously logical. It becomes tricky, and that's why that's all put there. When you have a couple of positions open, then it becomes necessary, to check that very carefully. Okay, margin level is the last one we're going to look at, and that is, for me, is like an indicator to see how much you understand of risk management or not. Right. The reason why I tell that is the following. That's the ratio of how much equity you've got to the amount of margin you used, and it shows it as a percentage. So you've got equity there of 492.551, and it's actually more digits there. I'm going to talk about that now. And the margin in that case is 127.49, and there's actually more digits. It only shows 2 there. And you work that out as a percentage. Divided by 100, it gives you 3,663. So you've got you've got enough space there. Your risk management in this case is very, very good. Okay, so what you guys will see, that if you work that out, you'll see there's a small difference in the digits between what it works out there. Somebody picked it up and reported it, and we kind of went and checked what's going on. And what goes on in the fact is that it's only displays 2 there, but it's only actually showing more. When it calculates that, it's showing more. So when you work it out just using those 2, then it looks like there's a small difference, but in actual fact, they use, for the calculation there, they use all the digits there. So it's not a problem there. We just had some guys thinking there might be a problem with MetaTrader, so we sorted it out. So there is no problem. Right. Now, I just want to get back to that. When you start trading with huge amounts of your account, right? If you open a position, and I want to give you an example of that. Let's say this is now a demo account, and that's another reason for the demo account. It's just test these things out. For you to get understanding, when you simply read something, you don't get a lot of understanding. When you start practicing it, when you get hands-on with it, then your understanding grows. Those neurological pathways get thicker. You make it your own. We talk in the seminars about, we share this knowledge, we share the method, we share the knowledge about what technical analysis is, the method, money management. But it's one thing to get it as a gift. It's another thing to open that gift and to make it your own. And that's what happens in the mind. That's the third part of that foundation. You have to open the gift. You have to open these things and play with it and understand it and get to know it. That's the part that takes time, and then you have to invest your time in. Right, so let's say you don't understand yet, you're just beginning, and you open a position and you don't really understand. You open a position with 8 lots, so you don't know about lot sizing and those sorts of things yet, and you sell. This is a demo account, please. I'm not gonna risk anything here. So immediately you'll see it's a huge position. There's a huge amount of margin that's been deducted. And very, very quickly you can wipe your account. If you didn't have a big account, now this is a demo account, a big account, I should actually get a lower one to see the effect. So if I had a much smaller account here, it's a $5,000 account, and I opened this huge position without knowing, my risk management and lot sizing, then it's almost, a big portion of your account is taken out as margin, and you haven't got a lot left. So that's actually a good tip for next time, if you think about it. Right, so that's important to experiment in the beginning with. if you blow accounts, please blow a demo account. Don't blow a live account. It's not necessary. Train yourself. Get it right. It's almost like, I tell the guys, it's almost like a pilot. A pilot gets theoretical training, and then they train on simulators. So that means that they know they're going to make mistakes. So rather than crash planes, which is very dangerous, obviously, they do it in a simulator. They train and they train. They make their mistakes there. They learn and they grow. Part of the mastery process. If you don't try, you're never going to learn and you're never going to grow. So you have to try. Just manage your risk well. So our simulator, like the pilots, is our demo account. That's where we try these things and make it our own practice. So you will see the effect of on a small account of taking two big positions. You'll see it here. You see that thing drastically also getting less there. So right now, if you do not listen to me and you open a live account and you just start playing around there and you don't know, do your risk management and so on, then you might receive what we call a margin call. And what that means is there's the positions you're taking is too big for the account size. So if you especially have a loss, then and there's too little of your account left, then you receive a margin call that tells you, listen, please deposit more funds or close some of your open positions. Right. And this is even worse. So if you don't listen, then the broker, and it's in the contract, has to take action on your account. So if you receive a stop out call, that's very sad, because then that means most of your account is gone. So there's not much left. So you have to then close it out, or they have to close it out for you, or else any profitable, if there's still profitable positions, they will be closed out, a free margin, or just all your positions will be closed out just to save your account. Because what we do not want is we don't want our account to go into the negative. Forex Time has got some insurance to cover that in case of certain events, but that's not the position you want to be in ever. So we always suggest that to prevent this, we trade with a smaller part of your account. That's very, very important. It's not only important for your account, it's important for your whole mental state, the ability to stay focused, to stay relaxed. That's almost like I tell the guys, it's like when you get a bicycle, you don't know how to ride it yet, but now you want to go and make a somersault with a bicycle. I mean, you get it, you fall very hard. So you must train properly, step by step by step. Then you will eventually get to a place where you can safely make somersaults, but only after you've trained. Right. So where do I find out? How do I know where I will get a margin call? I hope you never get that. If you trade with a small part of your account, then you should never get anything like this. But again, I know guys that they don't like to keep all their money. We've got in Forex Time, we've got like wallets, and you can keep some of your money in a wallet. It doesn't have to be in your active account. So I know some people keep their money in the wallet, and then put a small portion that they want to trade with in their live account and trade with that. So that's a little bit different. So then these things become important. You just have to monitor them quickly. So where do we find out where this will happen? Right in the beginning, or what you go is you go into accounts overview. Then it'll bring up all the different accounts. And I've chosen the Sense account first, because that's a very popular account in the beginning for the guys to test it on. And like I said, do test it, please, but on a demo. And only when you're proficient on the demo, when your simple, well-defined method, your money management has been trained, you've trained it well, and you can handle it on a demo, then you open a Sense account, and then a shares, or then a standard account. Right. So in this case, we're going to click on that. We're going to look at the margin calls and so on of the Sense accounts. So you open it up, there'll be a menu, and then it gives you the margin call and stop out levels. So 60%, 40%. So if there's less than 60% of your account left, when you've opened positions and the positions drop, you've got a loss, then you'll receive a call from us. So, and when it gets less than 40%, then we're going to stop it out to save your account. Right, on a standard account, you follow the same procedure, and then this is the margin call and stop out. You see it's a little bit lower, and there's a reason for that. Normally, the guys that open a standard account has got more skill, so they know how to manage their account, their risk a little better. With the ECN, this is where we use other liquidity providers, ECN Euro and ECN. So you'll see the margin call is a lot higher there. Stop out is higher. That's because it's given. It's ECN account stands for electronic commercial network, communications network, and that's given through to bigger liquidity providers. Right. Okay. Another common question we get, something some people misunderstand in the beginning, and they get a nasty surprise, is what is swaps? Now, swaps is the interest earned or payable for trades that you keep overnight. So if you have a longer term trade that you keep overnight, then you're going to see there's either deductions or money added to your account, depending on how you bought and sold, and when you bought and sold, and your position. So we're going to look at what that happens. Now, normally, or how that happens. Normally, a long swap means you have a long position that you keep overnight, and normally you pay interest there. When you have a short swap and you keep a short position overnight, then you get paid there. You get some interest, but not always. Depends on the instrument, right? Some guys ask me, where do I find out where that swaps is? We're going to see that as well. If we don't, I'll show it to you. Right, where you get that information from. Now, there's two ways that those interests are paid or earned or paid, and that you've got your normal daily swaps. And then on Wednesday, you have actually 3 days that's calculated, because the weekend, the 2 days in the weekend, if your position is open over a weekend, well, that is when weekend swaps are also calculated. It's a bit delayed. Now, don't ask any technical questions why they do it on a Wednesday. There's reasons for that, and it's technical reasons, administrative reasons. So some guys don't like it. They want on Monday, but there's nothing we can do about that, guys. So where you find out what the swaps are is if you choose a currency pair, you right-click there, it's the market watch, and you go to specifications, and it brings up a list of all the specifications, the contract specifications of that contract. And if you scroll down, you'll see there swaps long. You're going to pay 11.5 points in points. It's quoted in points, and for short, you're going to earn 4.5 points for a position. No, that's per lot. Sorry, that's per lot. We'll work out a couple of examples now. So let's look at an example, a couple of them, so you understand. Time is still going, right? Example 1, we have a open one lot position. It's long. We opened it on Thursday, and that's after Wednesday, and we closed it on Friday. Right, so it's one night. So we bought, so it was only Thursday night. Friday we closed it. So it's one lot, 1,000 times one night times the amount of points. Remember, that is in points. That's for points. We earn 11.5. We pay 11.5 per point, and then you get a 11.5. So that's what your overnight position, or your overnight swap for that position is. Right. So as you can see, it's not a lot if you consider that it's one lot, but it can add up, especially if you leave the positions open very, very long. So that's something to keep in mind. Okay, let's look at another one. Same currency there, 4.5. This time we're going to earn it because we've got a short position. Again, one lot to make it easy. Short position on Thursday, closed on Tuesday. So that's 3 nights. So it's Thursday night, Friday night, Monday night, and then Tuesday we closed it. So it's 3 nights, one lot, 3 nights per point, 4.5 per point, and we earn $13.5. Right, not a lot of money. And again, there's certain strategies that tend to use the fact that you can actually earn over time, but you have to know what you're doing. Okay, but very but some guys get a nasty surprise when they have swaps open or positions open over Wednesdays, and then you don't know what's going on. Okay, so let's look at a couple of examples. Same example, Euro USD 4.5. It's one lot. We shorted it on Monday and we closed it on Thursday. Right, so it's 3 nights plus the 2 extra because it's over a Wednesday. Very important. Plus the 2 nights. We had one lot, 5 nights now because of the swap, Wednesday swap, weekend swaps, 4.5 per point, and we've had 22.5. Right, it's a nice surprise. Okay, but if you had a long position, then it's the opposite. One position, open it long on Wednesday, closed it on Thursday, so it's Wednesday night. But because it's Wednesday night, there's swaps involved. So you get the weekend swaps added. And then you pay 34 for that position. Right. So it's important this. Not in the beginning, but if you've got long, keep it long positions and it's open. Let's look at another opportunity or another example here. This is a little bit of a longer one. So 5 nights plus the weekend. So it was on a Thursday and we closed it on a Thursday. Again, one lot, 7 nights. And there you earn some money there, some interest there. Okay, looks like we've gone all through all the basics of our agenda. Now, like I said, very important. If you're gonna listen, if you heard this for the first time, it might sound very confusing. Okay, so don't worry. As you repeat it, as you listen to it again, and this is the short videos is very handy. There's longer ones as well. You'll also find on the educational website where they explain some of the things in conjunction with others, how to work out those slot sizes and so on. So please go and watch those things. There's a number of options available for you. You've got that. You can contact us. You can go to webinars, seminars, or you can attend webinars. You can look at the recorded webinars. Some guys asked me where that is. So I'm going to show you quickly. When you log onto your account, using the bandwidth there, and you go to education. If you're not logged on, you can access that short videos, long videos, but to be able to get the ebooks that you can freely download, you have to log on as well as to see the recorded webinars. Then you go to webinars, click on education webinars. There's the upcoming ones. I've got another one coming up in a couple of days. There's some more, and there's the very useful ones. So you've got the recorded past webinars. Very easy to watch. You just click on it, and it starts playing, and you can click on that and you can go ahead there. So there you can, if you need to repeat some things and you want to check again part of the learning process, then that's where you can go. So there's a lot of useful information here that you can go and check questions that you need answered. And the nice thing about recorded webinars is if you know this thing, you just just scroll forward. So it's a very effective use of your time. Right. And if you still have questions, you can email me. We use Skype support groups, Skype sessions that we talk to guys, and that's also very useful. Makes a big difference to the guys that are really serious about this business. Right. So let's see if there's any other questions that you guys have. Lisha, high or low volatility markets, which is best to trade? Volatility, the higher the volatility, the more you get. it goes. Unfortunately, we had an internet drop here this side. So I lost some internet connection here. So luckily I've got a backup one. Can you activated that quickly? Can you guys hear me again? Hello, anybody here? Right. Can you guys hear me? We had a drop in the internet. Now you can hear again. That's good. That's amazing. I actually lost the internet and then it came back on again. And now it seems it dropped again and my backup dropped. Right, Herman, just can, can you guys hear me? Yeah, I had a drop again. So I just want to check. Seems it's right. I'm assuming you guys can hear me. Okay. So remember what we said. Let's just go back to that presentation of ours at the beginning. We talked about the currency pairs with the majors, where 80% of the volume is generated. There's low volatility. So there's lots of people trading high volume, low volatility. Low volatility means the market structures are a little bit more stable. So to answer your question, Elisha, it is definitely low volatility. Okay, any other questions? Any other questions? If there's no more questions, then we can close the session. I'm just still wondering with this internet if you guys can actually hear me. Okay, let's ask a question here. Let's check some people that are still here. Smarty, can you hear me? Nicholas, can you hear me? My system is showing you still online. Michael, Nicholas. Smarty, yes. Jose, okay. So now I'm sure you can hear me. It's always a bit of a guess. If if I don't get response, if you guys are wondering, are you still there or not? So there's no use talking to myself here. Right. Okay, recorded webinars are useful in the sense of you can always go back and you can listen to it again. I know time is an issue, but when you're building your skill, you have to devote some of your time to learning. What we went through just now is let me just go here. That is my email address. If you've got any questions, please guys email me. Go and check on the website. If you don't understand, email me and we can do a Skype session together. So we explain, and especially when you get going, especially when you start understanding, you get your method, and you're trading, and this doesn't feel like something is missing. Most of the time, it's something in it's something in that foundation that is not right. And it's very difficult to identify it yourself. If you've got a friend or a mentor or somebody that knows trading, then you can go to them. But don't just sit. If you try on your own for too long, then you get discouraged and you leave it. And this is a skill that I always say in the seminars. This is a skill that everybody needs, even if it's just the basics, because we are all long-term traders, guys. All of us want to retrade. We want to retire one day. If you want to retire one day, it means you are in actual fact now already a long-term trader, building up a portfolio slowly over the time that you're working. And if you've got a skill, if you understand how to look at what's going on in charts, on the chart, you understand technical analysis, and you will be able to see, even if you look at your current pension or annuity funds, you ask your financial planner, where are your funds invested, and you look at those. You can through the internet access those charts, look at those funds, where are they invested, what does the charts look like. If it's on a downtrend, there might be some trouble. So ask advice, and then as soon as your financial advisor, I can guarantee you, as soon as your financial advisor tells you or sees that you're interested and you're knowledgeable, he's going to treat you differently. So if you're not satisfied with your growth and you see some of your funds are growing negatively, ask him for advice. Ask him, listen, check for me. That's why you pay him in actual fact. Tell him to look for funds that's at least not in a downtrend, but it might be in an uptrend, or that's not actually not losing. It might be in a range or whatever. But ask his advice, and you'll see it'll make a difference over time, over many years. That kind of a, not daily but weekly, monthly, that kind of a management makes a big difference to your portfolio. So, and except or in addition to that, not all people will be able to go through the process and become are talented traders to trade in the lower time frames, but some are. And those talented traders, what we do for them is we use Forex Time Invest. So what we do with this, and you can also see that on the let me just get in here on the website. What we do is we tell those guys, listen, come to us, open a invest account, and then what happens is we track his performance. And you as a guy that's still learning, or that perhaps you don't really want to trade actively, you can actually see how these guys perform. So you can see the equity curves, you can read some of their statistics and so on. And what you actually can do is you can take a little bit of money and invest it here and see it, and these guys trade it for you, and then they do some profit sharing. They actually, of the profit they make for you, they get a portion and you get the rest. So in this case, it's you get 30% meta and you get 70%. So that's another way of trading where you're actually trading another guy's equity curve. So these people are already proficient. It's still a risk. You have to manage your risk. It's still a form of trading. You are managing another trader that's actually already proven himself or herself. So that's a very exciting option, even for guys that don't actively want to become traders, but just to have another instrument in your portfolio that you can over time grow. So anyway, time is up. So I hope you learned something. And just before I go, see there's another Vive. My second question: do we use a technical? Do we need an economic calendar? That's actually a very, very good question to close out with. That's my last question I'm going to take. Vive, yes and no. We are technical traders, so we look at the chart, we look at the effects of events and what people did. So when we look at a chart like this one, we can see the effects. We don't know what happened there exactly, but we can see the effects of it. We can see there was more buyers than sellers there. We can see a structure there. For instance, is a downward structure, is a downtrend. There's an upward structure there. There's a down structure. Right. Now, if you trade the higher time frames, then when the news are, you might still want to check, because what the news are going to be, if you're not the economist, it's going to be difficult to discern anyway. Understand? We look at the charts, but if you've got open positions or you're planning to take a position, then it's wise perhaps to look at the economic calendar, yes, and see if there's a very big event coming up, like possibly even a daily or weekly trend changing event, like the non-payment non-farm payroll report that's coming out, then you might want to delay your trade if you want. Some guys feel no, the higher time frames, 4 hours, even 4 hours and dailies and weeklies, they don't worry about structure, take their trades. Other guys feel no, they'll just check and wait until after the event. So it's your choice. But on the lower time frames, it's definitely it's definitely effect. So if you're trading on the lower time frames, like the 15 minutes, the 5 minutes, and so forth, and you want to take a trade just before the event when there's a possibility of a lot of whipsawing in the market, then it's not a good idea. So if you're low time, please go and look at the calendar. Don't take a trade just before a big event. Rather wait a little bit and see what the market structure does. Definitely, we don't try when is the events you don't want to take a position and then you get whipsawed out, or you might not want to be in a position and you have some nice profit and then there's a whipsaw and it cuts you out, takes all your profit, and you have to protect your account. You have to take a loss. So yes, so it's not an easy answer. Depends on you, but I hope you understand what I said. Okay, thank you guys. Have a nice day, and yes, keep on learning, keep on growing, keep on trying. But if you don't know what you're doing, try it on a demo. Okay.